Good evening, friends. Welcome you all to this webinar. I am starting this webinar in terms of the areas which I am covering over here. The first is new income tax bill, which is recently been passed in the budget, and some major section-wise changes in new income tax bill, old versus new tax regime, and why tax planning earlier is a superpower. Myself, Vishal Gupta. I am partner with Anil K. Goel Associates since last 14 years, and my association with AKG Group is more than 20 years. And I qualified in May 2002, and post that I am in practice working with Anil Goel Associates since last 20 years. So the presentation includes new income tax bill, new major section-wise changes in IT bill, old versus new regime comparison, and the early tax planning beneficials. And then the last, we can have a question answer sessions also. So guys, the key features with income tax bill, the most important thing is that this bill has been come after 60 years, replacing the old Income Tax Act of 1961. This is a major historical change the government has done, which they are planning since last 5 years. The effective date is 1st April 2026. The primary goal is to make it more simplify, outdated language of 1961 Act to be replaced, uses clear, easy language to reduce confusion and disputes. We'll talk about this later. New section, new structure is like the old Income Tax Act 1961 has 819 scattered sections. So in the new income tax bill, they have reduced the sections, merged a lot of sections, and make it 536 structured sections in 23 chapters. Outcome will be as far as we all must have gone through this bill, they try to make it less confusion, reduce litigation in a modern and taxpayer friendly framework. The other features, now the earlier, as everybody knows that in the old Income Tax Act 1961, there are two nomenclatures relating to the year goes on, like a previous year and an assessment year. Now in the new income tax bill, they have made it very simple, no confusion, helpful as a simple concept for filing and compliances, which is a tax year. So for example, till 31st March 2026, you have two nomenclatures. One is a previous year and one is assessment year. For previous year 25-26, the assessment year is 26-27. But now from 1st April 2026, it's only a tax year you need to know, and all the filings, all the compliances related to the tax year now. This is a very, very good thing which has been introduced, because this is what the worldwide all the countries follow. They don't have the concept of any previous year or assessment year. Only one tax year concept goes over there. So the digital first approach is already going on. The department is already rigorously working since last 3-4 years, to reduce the manual intervention in processing the returns and assessments. So more detail might have been they introduced in this income tax bill, and it will be more faceless assessments, online compliances and notices. The result will be less human interaction, less corruption, and faster processing. So digital approach is only helping the department as well as the assessee to file the compliances on time, and so that they can also doing the faster processing of the ITR compliances. No major changes in tax rates. The new income tax bill might be people expecting that they will do some changes in the tax rates or tax structures also. But as a first step, they have only did the structure and simplification in the act, and rates are largely unchanged for stability. So the focus is on more simplification rather than on increasing taxes. Digital assets, this is the concept which already been introduced 2 to 3 years back, but no major guidelines or a detailed, the treatments in the taxation has been involved. But in the new income tax bill, they have clearly defined and includes cryptocurrencies and other virtual digital assets. Expanded search powers. This is little controversial. Like earlier in the cases of search and seizure, serious investigations, the department will collect the data to a limited sources. But now they have been given a powers that they can collect the data of the assessee through the email, social media, digital accounts, all the modes, whatever available. Major point is that it will affect the privacy concerns of the assessee. So I would advise that the professionals should guide their clients that whatever the transactions they are doing, they must know that any certain point of time, the department can collect the information from any other digital mode also. Reduce complexity. Sections are reduced. Earlier 819, now 536. Reorganized and merged. Better structure, easier navigation, understand for taxpayers and practitioners. Key resources, what to watch for to understand the act so that you are stay ahead of the curve. New sections to memorize, easy to memorize because now they have only given the numbers. There is no A, B, C, D in any of the sections involved. They might have sub clauses, but only the numbers are need to be followed. Just like for exemptions, it is 11. For 80D medical insurance, it is 126. For rebates, it is 156. New regime is 202 and 263 is for return filing. In the other slide, I have only list down all these also, which I'll show you later on. Controversies, the only that digital powers has been given to the department. So everybody should be very much conscious while dealing any of the transactions that they can be later on asked by the department as per the powers given to them. Implementation, the bill is effective from 1st April 2026, but make sure that till March 2026, you have to follow the old Income Tax Act. So all the compliances, all the provisions of earlier Income Tax Act of 1961 will be applicable till 31st March 2026. This is only, I have highlighted over here what are the major areas where the sections, they have changed. Like in new tax regimes, earlier it is 115 BAC, now it is 202. Exemptions under section 10, now it is section 11. House property, which is under section 24, now they made it 22. Rebate 87A changed to 156. Medical insurance to 80D to 126. And return filing, which is 139, has been changed to section 263. Major structure overhauls, TDS provisions. Earlier was scattered in so many clauses like ABC under section 194 for non-salaried. So they have merged it into one section, which is 393. In 393, section 195 is also merged, but that is in subclause 2, and the domestic deductions are in subclause 1. For salary, earlier it was 192, now it is 392. Deductions like 80C, 80D, 80G, old separate complex sections, new renumbered, reorganized, like 80D has become 126 for a cleaner structure. What changed? Section numbers completely renumbered. This is the major thing because earlier there are so many sections with A, B, C, D, E, F, but now only single number will be renumbered in these sections. TDS merged in section 393. All TDS, whether it's a salary, only salary is 392. Other than salary, all are merged in 393. Introduction of tax year, all assessment year, previous year confusions has gone now. Structured, simplify, reduce the sections 819 to 536 sections. What did not change? Tax rates are largely same. No major changes are there. Core concept of income and deductions are same. Basic tax principles and penalties are same. So overall tax liability for most is unchanged. In nutshell, what is the new income tax bill is like? It is simpler tax system, less litigation, better compliances, more transparency, and major digitized modernization tax system. What is not? There is no drastic change to tax rates and core principles. So regarding the income tax bill, I have already covered the highlights, what I feel like to share with you. So if anybody has any questions related to the same, we can discuss that. Because otherwise I need to move to the another section to discuss. Anybody is there? Okay, you can still recall. If anything is there, we can take at the end of the session also. So I'm moving to a next section. So this is, a lot of queries we as a professional also receive regarding old tax regime and a new tax regime. People are still confused whether they go for a old tax regime or a new tax regime. So I just only highlighted few of them. It's like that the tax rates is a major, thing difference between an old and a new. Because in old there are only 3 slabs, and now in the new there are 8 slabs. We'll discuss about the slabs in another slide. Deductions. In old tax regime, you have so many deductions and exemptions available to claim for. In the new tax regime, mostly not allowed. Complexity, many calculations, because when you prepare your tax computations, you prepare your income in different heads, then you apply your deductions and exemptions, and then you arrive at the final tax liability. In the new tax regime, they are mostly simple, straightforward, because no deductions, exemptions are allowed. So you just have to calculate your income and the tax will be calculated accordingly. Standard deduction for salaried employees, it is 50,000 in the old tax regime. They have increased to 75,000 in the new tax regime. But this is for salaried employees only. Best for people who have so many deductions and good for people having fewer deductions. So in new tax regime, they discourage deductions, and in the old tax regime, they give you benefit of deductions and exemptions. This is a slab, which is old regime slab and a new regime slab. So you can clearly see over there that up to 10 lakh, the 30% tax will be allowed after 10 lakhs, and in the new tax regime, after 24 lakhs. So if you having a 24 lakh rupees of income, then in the old tax regime, your tax liability somewhere is around 6 lakh. And in the new tax regime, it is only 3 lakh. So this is the major change, and they covered a major section of taxpayers in this bracket, so that more people will come under the tax bracket and they do the filings and everything. So they increase the slab so that people don't have to pay much tax and they can disclose their incomes also. So in the old tax, because it's a straight away 30% after 10 lakhs, so major tax liabilities to be calculated with the people having more than 10 lakhs of income in a year. Who can choose the old regime? The one who invest heavily. Suppose if somebody is already doing it since last 3, 4, 5 years, so they still do it under Section 80C, PPF, ELSS, LIC. They have a home loan also for which they are paying interest and EMI. And you will have an HRA also and an LT also. So old tax regime, the people, those who are having, the deductions in these sections and exemptions, then they could probably still check if old can be beneficial to them to check their income tax liability to be paid. For a new regime, nothing has to be think about. They can straight away, calculate their income, don't have any traditional deductions. They can simple hassle-free filing will be there, and you're a salary with minimum investments. So in this case, new tax regime can be straightforward and can be adopted for. Verdict: old, more deductions, higher taxes; new, fewer deductions, lower rates, simplicity. I just only highlight one thing over there. The new regime, the processing of the ITRs could be faster because there is no cross verifications of any deductions or exemptions need to be done by the department as well. In old tax regime, if you have so many deductions like HRA, like donations and everything, there the processing could take little more time. and your refunds, if you have, could be delayed. But in new tax regime, since there is no as a claim tax investment over there, so department can straight away check whether the slabs are correctly adopted for, and they can do the faster processing of the returns. Now I'm coming why the tax planning at the start of the year is beneficial to the assessee instead of going at the last minute. So first of all, you have to change your approach. Be the first one, as not as a March taxpayer. Start your planning in the first month of the start of the tax year. It will help you in better financial discipline so that you can spread across your investments, depend upon your cash flow. Maximum user options, since you can initially analyze and plan accordingly, so you can see whether how much you need to invest in ATC, in medical insurance, in NPS, without any last minute rush. Time to choose wisely. You can choose, if you start early, you know which of the investments are helpful in tax saving as well as give you a better returns later on, and set your goals and your convenience as well. If you do early start, then definitely you have a long-term benefits of early action, no stress, you can easily manage. Compounding benefit is there because if you do the investment from the start of the year, you got a better, higher potential returns, especially in ELSS schemes and others. Avoid last-minute mistakes, buying unsuitable insurance policy, because at the last, when you don't have a choice, you suddenly end up in buying something which is not, fulfilling your goals. Locking your money in low return products, and missing documentation deadlines. The most important that when the March is coming, you need to do investments, and sometimes your documents are not available with you or you're not getting on time will increase your stress. So plan early, make informed, and make rational choices. Practical financial benefits is that if you do the planning from the start of the year, you can manage your cash flows and your tax liability uh, early start of the financial year. So better tax liability management is like you can estimate your total income and taxes in advance, adjust TDS with your employer correctly, plan advance tax payments towards penalties and interest. So this is very important because we come across a lot of clients and a lot of taxpayers that since they do not estimate their income in advance properly, so when they have to deposit their advance tax, they end up in paying more interest and penalties because they are not depositing as per the calculations. So it will be really helpful if you do the estimation in advance from the early of the financial year, so that when you have to pay advance tax in 4 installments, you could have saved more tax in more cash flow prospect, that you don't end up in paying more penalties and interest. So cash flow planning is definitely no sudden financial burden in March. You don't have to do in lump sum. Evenly distribute your investments and no disruptions to monthly expenses, because now you are doing investments on a periodical basis. You are depositing your taxes on time, so you're saving money in any case. Tax planning is not just about saving tax. It's about smart financial management. Start at the beginning. Why I'm emphasizing is that it will let you to save more, invest wisely, and stay stress free. So plan early, save better, and grow your wealth efficiently. Your action plan for starting April 2026. So the first step is that you need to project your annual income and tax liability. So if you have too many deductions, then compare your old regime versus new regime based on an investment plan. Automate, do some automation, like if you are doing investments in PPF, NPS, or in SIPs, do it on a periodical basis instead of lump sum. Submit your investment declaration to your employer for correct TDS. This is one of the point which is very, very important for those who are doing jobs in the industry or anywhere. That investment declaration is a must to give to your employer, so that your TDS annual tax liability will be distributed through TDS on a monthly basis. If you don't give your investment declaration on time, they assume that you haven't done any investment, and then they will deduct the TDS accordingly. And at the end of the year, if you give proofs and everything, you need to claim a refund from the department. So instead of that, if you give investment declaration on time, the employer have a sufficient time to, calculate the correct TDS which need to be deducted monthly. Right? So this is what, I thought to share with you. So any questions you have to ask in any of these sections now, so we can take it forward. Anybody's there?
Hi, you can just raise your hand to ask the questions. Yes, Abhishek Sahai, you can ask now.
Yeah, Abhishek. He's still muted. Yeah, I think we unmute हुआ था. अभी unmute हुआ था.
Yeah, I think I must be audible now, right?
Yeah, Abhishek, yeah,
Yeah,
please.
yeah, okay. Sorry about that. It's the first time. Mostly we are on the Zoom, so this is the Microsoft. It's a little
Okay,
tricky.
no
So the
problem.
only question is for the salaried people,
Yeah.
can they opt for the old regime and subsequently if they want to go for the new regime, or there's a restriction that once you start filing in the new regime, then you cannot go
Mhm.
back to old regime. Is that correct?
Abhishek, there are two, three things involved into it. Yes, at the first level, you are correct. When you give the declaration to your employer, you need to choose whether you are going for a old tax regime or a new tax regime,
Correct.
right? But
Yeah.
some of the industries, they open a window after 6 months or a 7 months also, that if initially you choose one regime, you can still choose to reverse it or change it. But most of the companies don't allow to change in between. So normally, if you declare new regime, then they will follow your new regime. If you declare old regime, they will follow your old regime. And when at the time of filing of your tax return, you have a choice whether you would go for an old regime or a new regime.
Yeah, my question was regarding the income tax law.
Mhm.
There's no restriction. We can file either way, right?
Yeah. At the time of filing, there is no restriction. But the employers have actually made their policies, because you see, it is, if everybody is choosing in first month as a new, and then in the second month they again come and say, no ma'am, take it, make it old. So from the ease of convenience point of view, they made it mandatory that whatever the option you will choose at the first month or at the time of the investment declaration, they will follow that throughout the year, and only at the timing of filing of tax return you can change your regime.
Yeah, I do understand it is for the TDS deducted by the company. They would follow the
Exactly.
same regime. But at the
Exactly.
time of filing, the income tax department does not restrict ourselves. It's our
No,
prerogative which one to go for, right?
exactly. There is no
Okay.
restriction from the department.
Okay. Just
Yeah.
that was my query, sir.
Yeah.
Thank you, Mr. Vishal.
Thank you.
So you can ask now, Vinay sir.
Yeah, hello Vishal. I am Vinay Bhatia here. And I am a retired person. Anything for the retired persons, those who are receiving pensions?
Sir, if you are receiving a pension, there is no much. You can still go for a new regime and an old tax regime that is available with you also. And the standard deduction, which is 75,000, is allowed from your pension. So there is nothing more than that is available for a pensioners. So
Uh,
you still have you don't have to give any declaration anywhere. So only at the time of filing of your tax return, you can compare your old regime and a new regime, whichever is beneficial to you. You can file your tax return accordingly.
in Earlier, there used to be a clause for the interest income. There was some exemption of around 50,000 and odd. It remain the same or something
No,
new
sir.
has come up?
In new tax regime, nothing is allowed, sir.
Nothing is allowed.
Yeah.
But I'm
Which
already
because there is,
shifted to, yeah, sorry.
so it is already allowed in the old tax regime. Nothing is
Mhm.
there in the new tax regime.
Okay, okay. Thank you, Vishal. Thank you.
Okay.
Any more questions?
We can make it more interactive if anybody has any other questions, any specific question even related to what we have discussed over here. I'm happy to attend that. Uh,
Yes, Alok, sir, you can ask now.
Yeah, Vishal, please explain me one thing or confirm me
mhm,
one thing, whether TDS deposited under old challan system
mhm,
can be consumed under
mhm.
new challan system from 1st April 25, 26 onwards or not. Like in earlier years, TDS challan can be adjusted against each other.
Mhm.
But can it be done now? Tax deposited under Section 194 can be adjusted in a challan of 393.
Alok, I have a doubt over here because this is a change in the challan numbers and the procedural aspect in the new income tax bill. So I didn't come across any of the practical things over as if now. But as per my understanding, I don't think so that will be allowed because this is a change of section numbers also over here. So I
So
don't
it
know how practically traces will going to link this to a new sections to a old section. If they link it, then I don't think so there'll be any problem. But as if now, I don't think so that will be possible at all.
that will not be allowed in future now.
I don't think so. I don't think so. This is my personal assessment. I don't think so.
Okay.
I think one more I think.
Manish Dubey, so you can ask a question now.
He's still on mute.
Am I audible now?
Yeah, Manish, you're on it.
Yeah, sir. So my question was that let's suppose I filed my return under the old tax regime, and
Yeah.
for the new for the next year I filed it under the new tax regime. So will I be able to do that or not? So it is completely my choice every year.
Look, Manish, there is only one exception over here that if
Mm-hmm.
you are not having business profession income, if you are having other than business profession income, you have a choice to change the regime every year, whichever is beneficial to you. But if you're having a business profession income, then only one exit is allowed from a base tax regime, which is a new tax regime. So if you want to move from new tax regime to old tax regime, only one exit is allowed. And once you come back to new, then next 5 year you cannot change your regime. But that is only for business profession, if income if you have.
Nothing for
Otherwise,
the salaried one.
otherwise you have an option to change regime every year.
For the salaried one only, right?
Yeah, for the salaried, for other sources, for house property, for capital gain, whatever income you have. In
Okay.
these four areas, if you have an income, you have a choice to switch regime every year.
Okay, sir. Got it. So I have one more question. It could not be relevant. So
Mhm,
it is about the salary component and structure when we design.
mhm, mhm.
So since we have new laws and new changes in the wages code
Yeah.
for each state, so do we need to keep minimum 2 to 3 salary components, or we can go with the just basic or HRA and this special allowance, or we need to also keep this uniform LT and a lot of things under the old regimes. It was there, right? So should we also focus onto that, or it is a
Um,
specific choice of an organization?
Manish, this is a very specific question related to labor law changes. Uh,
Yes,
I don't think so. There'll be any changes you can make to your structure. The only thing is that they have defined it now. Some of the components which you cannot go beyond that. Suppose earlier companies used to keep basic as 40% of their CTC or even 60-70%. But now you have to keep minimum 50% as your basic. So
right.
only some limitations they have introduced in the new labor law code, but I think the components they don't have any problems with that. So the components you can keep it the same as efficient salary structure you want to make it for an employee.
Okay, sir.
But yes, now earlier if you have anybody is having a 40% basic or a 30% basic, now you need to keep it minimum 50%.
50%. Yes, that is
Yeah.
there. Yeah, so that will be all from my side. Thank you.
Yeah. Yeah. Abhishek's value.
Abhishek, sir, you can ask now.
Okay. Yeah, Mr. Vishal, it's
Yeah.
regarding again the question about salaried employees in
Mhm.
the old regime, and it's about the old regime only, basically.
Yeah. Yeah.
So we can claim, been claiming LIC, PPF,
Mm.
medical
Yeah.
insurance,
Yeah.
HRA, LTA,
Yeah. Yeah.
NPS, is
Huh.
there any, as for the tax planning,
Yeah.
and if there is a home loan, one can claim I do understand the interest
Yeah.
component of that. Is there
Yeah.
anything else which I'm missing that you could enlighten me with, or all the people who are looking for that kind of thing? Because the salaries are very high, the tax component is very, very high. So take home is, compared to the salary is very less, what I feel, the amount of work we
Mhm.
put in, 14,
Mhm.
15 hours.
Mhm.
And so is there anything else I'm missing that you would want me to guide?
Sir, mostly the salaried guys, they normally have all these deductions and exemptions available only.
Yeah.
If you voluntarily make some donations to the organizations for a charity, that benefit can also be claimed at your end. But other than that,
Okay.
I don't think so. There is much available in terms of deductions and because everything you have already covered, like HRA you have covered, LTA you have covered, home loan
Right.
principal and interest you have already covered, 80D you have
Yeah.
already covered, your pension portion you have already covered. So
Correct.
other than that, I don't think so. There is much, more available over there. Some children education allowance is available, but that's a very minor thing, in that aspect and all.
Yeah.
So that is the only thing is that when you do the breakup of your salary with your employer, only at that time, what is the policy of your organization? You need to check as a fixed and a flexi component. So if you keep, flexi component open, so
Hmm.
there you could have saved your tax over there, like Sodexo passes like meal coupons and all. So some of the organizations keep as a fixed and a flexible component where you can play and save your more taxes. But in terms of deductions and exemptions, I think you already know most of them. You're already covered.
Okay. Thanks a
Yeah,
lot. Thanks a
yeah.
lot.
Thank you.
Yes, Arvind, sir, you can ask now.
Vishalji, Vishal sir, I just want to know for a common salaried person, what would you suggest as an expert? What regime they should uh, opt? Because every employee would rather prefer to have his taxes less during the year. So what should be suggested? Because the concept of they would not really understand more taxes, more savings, or those kinds of things. What would you suggest? We should suggest them. Anybody within the company.
Arvind, in that case, you need to first see how much salary you are having in an organization. As I already told you, if you have too many deductions, first of all, available with you, suppose if you have only 80C and 80D is there, then don't even think for a old tax regime, go straight away with the new tax regime. The old tax regime can only be assessed when you have an HRA, LTA, housing loan principal, and interest. If these three components you have, then only you can assess which is beneficial to you. If you don't have these things with you, then straight away I'm telling you, go for a new tax regime. In any case, it is going to be beneficial to you.
Understood. Thank you.
Mr. Sai already. Yeah, Mr. Sai, I think you raised your
No,
hand.
I was already covered. I think the hand has not been removed. I don't know how
Okay.
to, but
Okay. Okay. So thank you so much, guys. Thanks for your time and effort. And it will really privilege to, share my thoughts with you. Thank you so much.